So when we look at all the data we're getting, it's pretty clear cut that, one, the Fed is going to continue to increase interest rates even as the economy continues to slow. We've continued to got dollar headwinds that are really going to weigh on, company forecasts and revenues. And in fact, we actually expect that combination, along with some other items, to really result in greater downside risk to earnings expectations really through the balance of the year. So, over the last, several weeks, we've actually positioned the portfolio for that. We have gravitated into more defensive, or as we like to say, inelastic names with great dividend streams, whether they're increasing their dividends on an annual basis or ones that offer, like Verizon, for example, a really great dividend yield. So, I think the key for us is that we're always looking out 6 to 8 weeks or so, even though we have a longer term view. And the idea here is to kind of course correct and make sure that we don't really get hoodwinked or caught off guard by anything that's happening. It does happen from time to time, but the key here is to minimize that from happening.
And I love that the inelastic names. What are the inelastic names that are in the portfolio that offer a little bit of protection?
Sure. So we've got Verizon, like we said, and in today's increasingly connected world, I challenge you to find anyone that is going to go without their mobile phone service. American Waterworks, AWK, water utility. Water's making all sorts of headlines today in terms of shortages and droughts. But here's the thing: you can't live without it. So arguably, that's probably the most inelastic product out there, meaning that you'll pay no matter what because you need it to live.